The second half of 2025 is here, and if you've been investing, chances are you've been winning. The S&P 500 is up over 7.5% this year. My own portfolio over 11%, but I'm not here to flex. Today I want to show you 10 stocks, most of which I personally hold, that I believe are either undervalued, fairly priced, or in some cases too expensive to touch right now. I will break down each stock with a quick analysis, give it a clear label, buy, hold or sell, and explain my reasoning behind every decision. Stay until the end because stock number 10 might surprise you. Hey everyone, I'm Dominic and welcome back to the channel where we talk all things investing, finance and building long-term wealth. This video is not financial advice, but I will walk you through how I analyze stocks, manage my portfolio and think about risk and value. Number 1. ASML. ASML is one of my favorite European companies and it's the kind of business that's nearly impossible to compete with. They make the machines that make the chips, literally. They are a monopoly in EUV lithography tech. Nobody else builds what they build. So why is the stock flat this year? Mainly due to geopolitical tensions, especially the threat of 30% tariff from Trump on Europe exports. That uncertainly has dragged the stock down, but fundamentally ASML is still growing. Revenue up 15% year over year, profit up around 14%. It's well managed, has high margin and it's trading at a fair to slightly discounted valuation. I already hold ASML, but I'm seriously considering adding more soon. My rating? Buy. Number 2. PepsiCo. Pepsi is one of those classic dividend plays. Strong brand, predictable cash flow and it's currently 25% below its 5-year average valuation. So what's the catch? Market expectations are low right now due to declining volumes and pricing concerns. But this is Pepsi. They've weathered far worse in the past. I bought in back when the stock hit 129. As I record this, we are at around 146, plus I'm locked in with a solid 4% dividend yield. But at current prices, I see it as fairly valued. It's not a screaming buy, but also definitely not a sell. My rating? Hold. Number 3. Lockheed Martin. Let's talk about one of the most misunderstood stocks in my portfolio, LMT. It's down around 14-15% year to date. Their earnings dropped, EPS fell, they've written off billions from defense contracts. Sounds bad, right? But here's what I see. Stable revenues, strong backlog, massive cash flow, and unfortunately, the world is still in conflict, which means ongoing demand for defense systems. LMT is investing in cutting-edge military tech. Yes, it impacts short-term earnings, but long-term, it could pay off massively. I see this dip as an opportunity. My rating? Buy. Number 4. AMD. Now for a hot take. I've owned AMD for a while. I bought it at around $90 per share. Right now it's trading between $155 to $160. That's a 60% return in just a few months. But here's the thing, it's trading at 113x trailing earnings. Even forward PE is around 40x. Regulatory risk from China restrictions are growing. AI hype is priced in at a near perfect execution level. In short term, it's no longer cheap. Great company, solid growth, but the current valuation has no room for mistakes. I will likely trim or exit this position soon. So my rating? Sell. Number 5. Berkshire Hathaway. When Berkshire gets cheap, I pay attention. Right now it's trading at 1.55x book value, well below its recent highs and below the 5-year average. They've got $348 billion in cash on hand, giving Greg Abel a serious war chest after Buffett steps down. Yes, first quarter operating income dropped 14% due to weakness in insurance, but the core businesses, they are still solid. To me, this is a recession-proof defensive stock and a solid long-term value play. I recently added a huge portion of BRK shares to my portfolio, so my rating: buy. Number 6, Porsche. Now here's a wild card. Porsche, ticker P911, is one of the stocks in my portfolio that's currently in the red, down around 24% year to date. Why? US tariffs on EU auto imports, weak demand in China, EV margin compression, but look at the fundamentals. PE around 13, price to book 1.6, much cheaper than Ferrari or other luxury automakers. Yes, the market is pricing in short-term headwinds, but I believe it's severely undervaluing the strength of the Porsche brand over the long run. I'm not buying more just yet because I already have a large position, but if I didn't, I'd be jumping in. My rating: buy. Number 7, Microsoft. Microsoft is my second favorite stock of all time, and it's one of the best performers in my portfolio. My average cost $290, current price $500, that's a 70% return. The fundamentals are great. Revenue plus 13%, net income plus 18%, cloud growth plus 20%. But here's the catch: PE is around 39 right now. That's a bit rich even for Microsoft. Still, with their investment in OpenAI and dominance across enterprise, cloud and AI, I'm not selling anytime soon. My rating: hold. Number 8, Google. Google is one of the largest stock positions in my portfolio. My average buy-in was $142 per share. It's now up over 30%. The second quarter numbers were excellent. Revenue and profit both climbing. YouTube, search, cloud, everything's growing, but there are a few concerns. Antitrust lawsuits, massive AI capex spending, $75 billion. I still believe in Google's moat, but I'm not buying more at current prices. My rating: hold. Number 9 is Tesla. Okay, let's talk Tesla. This is the only stock on this list that I don't own and probably won't own unless something major changes. Why? Margins are falling, deliveries are down, valuation is still sky high, 167 times earnings. To me, the risk reward just doesn't make sense right now. Tesla is a great company, but the stock is priced like a flawless tech giant. If it even dips hard and becomes undervalued, I will consider it. My rating: sell. Number 10, Amazon. Finally, Amazon. My third favorite company after Microsoft and Google. I've held it for years. Amazon is a beast. E-commerce, EWS, their most profitable division, AI infrastructure, logistics, media, you name it. From a valuation standpoint, I think it's reasonable right now. Revenue plus 13%, profit plus 29%, AWS growth plus 20%, but I already bought aggressively under $200. Now I'm up 30 to 40%. I'm holding tight and waiting for the next opportunity. My rating: hold. So there you have it. 10 stocks I've personally analyzed, researched, and in most cases invested in. Some are screaming buys, some are solid long-term holds, and a few I'm ready to exit. But here's the key: I don't invest based on headlines. I use DCF models, fundamentals, cash flow, and price to sales when needed. I invest with a long-term mindset, and I try to let my money compound quietly in the background. If this kind of investing content helps you, consider subscribing. I share everything I learn, what I'm buying, what I'm avoiding, and what I'm watching next. And if you are curious what my next stock purchase will be, make sure to check one of the future videos. Thanks for watching, stay consistent and invest smart.